How is money created? Simply, we think that the treasury keeps on printing money all day long. That would be nice to do, but it is not the case. If that would be the case, the government loan would always be zero. In almost all the countries in the world, the money is created in the form of debt. Bank creates loan for people and businesses, which in turn deposit that money in their bank accounts. The banks in turn can use those deposits to loan money to other people, and the process goes on and on. This is facts, figures and theories. Welcome to this channel. If you are new to this channel, please don't forget to press that subscribe button and also press the bell icon so that you don't miss another update from us. In this video, we are going to explain about how money is created by banks and how the government checks and controls the infinite creation of money. We will also explain about the more traditional way of money creation. So, without further delay, let's get started. Before understanding what debt is, we must understand what a deposit is. When a person or business puts money into the bank account, it is called a deposit. Deposits can be money you are saving for long term or just a normal saving account used for everyday expenses. Saving accounts are generally paid interest. The bank collects all the deposit from its clients. So, when a person or business wants to take a loan from the bank to buy something, the bank uses deposit from its clients in order to make that loan. Long-term savers are paid interest in exchange for letting the bank use the deposit to make these loans. But money in checking account or current accounts can also be used by the bank to make this loan. Once that loan is made, the lender can either take the money as cash, but more typically, the lender deposits it back into the saving or checking account. This means the money can be used to make another loan by the bank, so the bank can relend the money again and again. This means virtually every unit of currency a bank lent out was at some point borrowed by someone else. The total amount of money in the economy is directly dependent on how many people and businesses have taken out loans. Even deposits made by people as income were almost certainly borrowed at some point by another people or business. If a business pays out its employee's paycheck using a bank overdraft loan, then the income deposited by the employee is the money borrowed by the business. So, it basically means that the bank can lend out same money indefinitely to create more and more money. No, that is not the case. There is a checking mechanism to that. To prevent banks from indefinitely lending out the same money over and over, there are reserve requirement rules in almost all the countries in the world. For every $100 loaned out, certain amount is to be kept as reserves by the bank. It basically means that the bank cannot use that reserve amount to make other loans. The reserve requirement can be held in the bank vaults as cash or on deposit with the Federal Reserve Bank. It raises another important question. If there is a reserve requirement, how is money created in the first place? Initially, when the government needs to spend money, it gets its revenue through taxes and by selling treasury bonds, which is effectively borrowing money from investors and banks, including the Federal Reserve Bank. The revenue it receives from sale of bonds is then injected into all the other banks as the government spends money, which is what creates the initial cash seed that all other lending is based on. It's a vicious cycle. The economy buys debt from the federal government, and the federal government on the other hand uses the cash to feed back the economy. Even though money is created by debt, we can say that it is backed by the value of goods and services that we use that debt to produce. Another question might arise. What happened before all these practices were common? The primary form of currency for thousands of years was gold and silver. These metals were mined and were minted into coins. If a government wanted to print more money, they would simply melt down existing coins, then mix the gold and silver with cheaper metals like iron and copper, then mint new coins. Paper money came into existence when the bank started to provide a piece of paper against the coins deposited. This is similar to certificates of deposit in the modern day banking. This piece of paper would be inscribed with the bank's information and the amount deposited. The holder of the paper could come back at a later date and request that amount in coin, or, like the modern day check, give another person authorization to withdraw some of the deposit. As more and more customers came into this bank, they standardized the certificates in set amounts and issued people what looked like modern day money. However, since each bank was issuing their own notes, one would need to go to each bank individually to request the coins, and then take them back to their own bank. The gold standard. Before debt was used as money, all the money in the world were backed by the gold and silver. Each dollar represented a specific amount of gold, and the banks needed to move gold reserve between them each time someone wrote a check. This process was very expensive and time-consuming. There was also a reserve requirement for the gold standard. The reserve was simply an amount of physical gold that a bank needed to be holding at all times. When checks were written, the bank used to physically ship gold in and out of the bank regularly. The shipment was generally done through rail, which made rail robberies very famous in the Hollywood. The gold standard was ended in late 1970s throughout the world. This brings us to the end of the video. What do you think about the video? Please write in the comments below. If you like this video, then please don't forget to press the like button. And finally, if you have not subscribed to this channel yet, please don't forget to hit the subscribe button and press the bell icon so that you don't miss another update from us. Thank you and see you again.